welcome to the Deep Dive. Today, we're looking at a company. I mean, its products are probably sitting in your house right now.
Literally.
Yeah.
In your kitchen, your garage, maybe even your medicine cabinet.
Exactly. We're talking about those plastic containers, the ones for paint, for ice cream, for engine oil. But this isn't just any container company. We're talking about a multi-billion rupee empire.
Right. And the company is Mold-Tek Packaging Ltd, or MTPL as we'll probably call it. It's so easy to just dismiss these things as, a simple commodity.
Just go plastic, yeah.
Just a pal. But MTPL is operating at a completely different level. They're at the premium end of what's called rigid packaging. And today, we're going to apply some cold, hard analysis.
This is straight from our company Brewing series at catalystandthecup. We're really trying to cut through all the noise,
all the chatter,
and get to the fundamental drivers. What makes this company tick? And what are the real tangible threats they're facing after making a huge financial bet? So for our sources today, we've gone through their annual reports, basically from FY20 all the way through to the latest FY25. And we've also looked at the investor conference calls up to late 2025.
And that focus is really important. We're deliberately weighting this analysis, the historical data, the stuff from FY23, FY24. That's our baseline. It's important context.
It sets the stage.
Exactly. But 70%, maybe more, of this deep dive is going to be focused on the future. The outlook for FY25 and beyond. We need to understand the payoff from their massive capital expenditure, their CapEx, and the growth drivers that are supposed to make that bet worthwhile.
So that brings us to our mission for today. The core thesis question we have to answer.
And it's a big one. It's essentially this. What is Mold-Tek Packaging's core business and product portfolio? And what real evidence exists that management can reliably execute this very ambitious strategy to defend its profitability and ensure structural growth for the next decade?
It's not just about growing. It's about growing sustainably, right? In what seems like a really competitive field.
Fiercely competitive. That's the key.
Okay, so before we dive into the deep end, let's just establish a clear definition. What is MTPL at its core?
Put simply, MTPL is India's largest producer of plastic packaging pails. They specialize in rigid packaging, and their business is split across 4 main segments.
And these are
pharmaceuticals, which is the new, exciting one, and then their traditional strongholds, paints, food, and FMCG, and lubricants.
So they're really embedded in the Indian economy, the quiet, almost invisible backbone for huge consumer and industrial sectors.
That's a perfect way to put it. Now, let's get to the heart of it, the investment thesis. What makes MTPL so hard to actually displace?
A big question.
It is. We need to talk about their sustainable competitive advantage. And, this is where that classic Warren Buffett idea comes in.
The moat.
The moat. What is it that protects them from the competition?
Okay, so let's unpack that. I mean, in a sector where you've got countless small local players who can probably churn out generic plastic buckets pretty cheaply, what gives MTPL this power? What's their technological or structural edge that lets them command a premium?
It's a fantastic question. And the moat here is really built on a dual foundation. It's not one single thing. It's innovation layered on top of deep vertical integration.
So they're not just selling a container.
Not at all. They're selling a complete branding and efficiency solution. The first and maybe most critical element of this moat is their pioneering adoption of in-mold labeling technology in India. IML.
IML. Now, I think for most of us, this is the thing that turns a generic white bucket into a premium product we see on the shelf.
That's it, exactly.
You see it on a high-end ice cream tub or those beautiful glossy paint cans from the big brands. We don't really think about it, but the packaging itself becomes a silent salesperson.
It is. And the question you ask is the right one. How does that aesthetic quality translate into a defensible, long-term business model?
Yeah. What stops someone else from just making pretty labels?
Well, it's about the process, the integration. See, with standard packaging, you manufacture the container, then you apply a sticker, a paper or plastic label after the fact.
Which can peel or get scuffed in transit.
Exactly. It looks cheap. IML, on the other hand, integrates this high-resolution photo quality graphic directly into the plastic during the injection molding process itself. The label and the container become one single piece of plastic.
Okay. So no peeling, no fading, no scuffing.
None. It gives you a level of durability and visual pop that you just can't get with a sticker. So for their big reputation-conscious clients, think about burger paints, Asian paints, Castrol. This is critical. It turns a commodity container into a premium marketing tool.
And that locks them in, because those brands can't afford to have their products looking subpar on the shelf.
Precisely. They're willing to pay a premium not just for a pail, but for the brand integrity that IML provides. It's an investment in their own brand equity.
That's a powerful technological lead.
Yeah.
But, technology can eventually be copied. Which I guess brings us to the second part of their moat.
It does. This is the backward integration piece, and specifically their in-house tool room facilities.
A tool room. It sounds mundane, but you're saying it's a major strategic asset.
It's a massive strategic asset. The tool room is where agility is literally manufactured. Having this facility integrated in-house means they can design, test, and develop new molds, new samples, new prototypes, all by themselves.
So they control the entire process from idea to final product.
The entire product development lifecycle. Their unique selling proposition here is speed. Think about it. A competitor who has to go to an external vendor for a new mold design faces delays, coordination problems, quality control issues.
Right.
MTPL can deliver faster product development and much, much quicker turnarounds. This is a huge deal, and it's explicitly one of the main reasons they believe they can win in their newest strategic focus, the pharma sector.
Because pharma is so highly regulated and needs very specific, often unique packaging.
And they need it fast for clinical trials, for product launches. This control over the mold design process is a non-price competitive advantage. It locks in clients who care more about speed to market and bespoke quality than they do about saving a few rupees on a generic container.
So if I'm a big client, I'm choosing MTPL. Not because they're the cheapest, but because their quality from IML and their speed from the tool room lets me launch a better looking, more durable product faster than anyone else.
That is the moat in a nutshell, and they've leveraged this across a really robust and, importantly, an increasingly diversified portfolio.
Right, they're not just a one-trick pony.
Not at all. We've seen them actively disrupt traditional packaging. Take the edible oil market. Historically, that was all about tin containers.
Which are heavy, expensive, and they can leak.
They leak, they dent. MTPL went in and converted major players. We're talking NK Protein, Goyle, Damani Gulab, from tin to their own proprietary square packs. That's a structural shift they created.
And they keep innovating even within that niche.
Yeah, they do. They recently added a new 10-liter size to their edible oil range. That shows they're not just resting on their laurels, they're actively trying to deepen their market share and find new growth avenues.
Okay, but this innovation is kind of useless if it's not protected. Anyone can make a square pack, can't they? What's their strategy around intellectual property?
This is a really crucial part of their defense. They went out and secured a patent for their distinctive square packs, but, getting the patent is really only half the battle.
Enforcement is the other half.
Enforcement is everything, and management has been very active, even aggressive, in enforcing their IP rights. We see in their reports that they're filing for declaratory judgments, for permanent injunctions against companies that are infringing on their designs.
So they're just sending a message.
A very clear message to the market, which is fragmented and full of small local copycats. The message is, if you copy us, we will use our significant legal resources to stop you. This turns their IP from just a piece of paper into an active, formidable, competitive barrier.
This is fascinating stuff. And if you want to get the full detailed breakdown of how these technologies like IML and the tool room actually translate into a long-term financial performance, you should join our YouTube channel.
That's right. It's called Catalyst and the Cup, and this is all part of our company brewing series where we get into all the details.
Now, you mentioned diversification earlier.
Yeah.
And I think that provides a kind of internal stabilizer for the business.
It's a huge benefit. It's easy to overlook, but mixing cyclical industries with essential ones is a very deliberate strategy.
So paint is cyclical, right? It depends on construction, home renovation, discretionary spending.
Exactly. But lubricants or edible oil, those are essentials. People need to eat, cars need oil, regardless of the economy.
And we saw how important that was during the pandemic.
We did. In FY 2021, management knew that discretionary spending on paint was going to take a hit. But the stability from the essential segments, from lubricants and FMCG, prevented a complete earnings collapse. That diversification smooths out the revenue streams over time, and crucially, it ensures they have continuous cash flow to fund R&D and their next big expansion.
Which brings us to the cost. This incredible IP-driven moat is clearly their bedrock. But the next big question has to be, how much did it cost to expand that moat?
And that is the perfect transition. With the moat established, let's get right into the financials, because this is where we find the crucial tension point that defines the entire investment case right now. We're talking about the high-stakes CapEx trade-off.
Okay, and this is where we have to bring in our second core conceptual model, Analyzing capital allocation. We often talk about this as the principle of delayed gratification.
That's a good way to frame it.
The logic is simple, but it can be painful for investors in the short term. You make these massive capital investments, which temporarily crush your profitability ratios, things like return on capital employed, or ROCE, but you do it with the promise of much, much higher growth in the future.
The question is always how much patience is required and how steep is that initial price you have to pay.
So let's look at the numbers. We need to see the historical performance to really grasp the scale of this bet they've made.
Right, so if you look at their revenue, it showed really impressive, steady growth for a while. It went from about 43,744 lakhs back in FY20 up to a peak of nearly 73,000 lakhs in FY23.
A very strong growth trajectory.
Very strong. But then the following years start to show the pressure from this massive expansion.
This is the inflection point we need to dig into. What happened around FY24?
FY24 is when the bill started coming due, so to speak, before the new assets were really online and generating revenue. Now, revenue did rebound strongly in FY25, climbing up to over 78,000 lakhs, which is great.
But the profitability tells a different story.
A very different story. The profitability metrics took a significant short-term hit. Net profit, or PAT, fell from over 8,000 lakhs in FY23 down to about 6,600 lakhs in FY24.
Wow, that's a big drop.
It is. And naturally, basic earnings per share, BEPS, followed suit. It dropped from around 24.40 down to just over 20. This drop is the signal. It's the direct impact of this huge new capacity coming online, but not being fully utilized yet. It's a drag on the entire P&L.
And the sheer size of this expansion is what makes it such a high-stakes bet. How much capital did they actually deploy in this cycle?
The commitment was massive, especially relative to their size. Over the 2 years leading up to FY23 and FY24, the company spent approximately 280 crores on capital expenditure.
280 crores?
Yes. And you have to understand, this wasn't just general maintenance. This was a huge strategic push designed to meet future commitments, particularly for the new grass and paint contract and their big pivot into pharma.
And the immediate, unavoidable consequence of adding all these expensive, not yet working assets to your balance sheet is what?
It's a drop in your efficiency ratios. Specifically, the asset turnover ratio gets hammered.
Okay, can you just quickly explain asset turnover for us?
Of course. It's a simple ratio that tells you how efficiently you're using your assets, your factories, your machines to generate sales. So if you invest 280 crores in new plants, and those plants are sitting idle or only running at, say, 50% capacity, that ratio plummets.
And when asset turnover drops, your ROCE, your return on capital employed, also drops?
It has to. It's simple math, and management is very upfront about this. They've explicitly said that the asset turnover ratio is currently low.
But they've given guidance on where it should be.
They have. They project that once these new assets are fully operational and running at high utilization rates, the ratio should cross 2.5. That's their target.
So this low current asset turnover ratio is the trade-off.
It is the physical manifestation of the ROCE trade-off. It's the cost of admission for all that future growth. As an investor, you have to weigh the certainty of this current depressed profitability against the promise of a much higher return from those assets in, say, 2 or 3 years.
So with a 280 crore spend, you'd expect them to take on a lot of debt. We have to look at their capital structure. Did they over-leverage the company to fund this ambition?
This is a really strong point in their favor, actually. They maintained remarkable discipline. If you look at their history, management has consistently worked to reduce leverage. The debt-to-equity ratio was quite high at 0.61.1 back in FY20.
A little spicy.
A little bit, but they systematically brought it down. By FY24, it was at an extremely healthy 0.22.1.
Wow. So how did they fund the CapEx then?
It shows they prioritize using internal cash flows and raising equity through things like a QIP and a rights issue over just loading up on debt. That's a really positive sign for their long-term stability.
But still, even with that discipline, that scale of CapEx must require some new borrowing. We need to see what the immediate cost of that debt was.
And that's the counterpoint. You're absolutely right. Despite the good leverage ratio, the total amount of debt did go up to help finance this expansion, and you see the impact crystal clear in one line item: finance costs.
Let me guess, they went up.
They almost doubled. Finance costs rose from about 387 lakhs in FY23 to nearly 535 lakhs in FY24.
Doubled.
That sharp increase is the direct cost of the recent borrowing for this 280 crore cycle. And this is where the risk lies. If the asset utilization gets delayed for any reason, this doubled finance cost becomes a serious continuous drag on their profits. It constrains the recovery of their earnings per share. The financial tension here is it's palpable.
And we also need to get granular on working capital. I mean, rapid expansion depends on smooth operations, but fast growth can really tie up your cash.
It absolutely can. High growth often means you have to extend more credit to your big new clients, which can temporarily strain your cash flow. Now, while detailed days sales outstanding figures aren't always broken out, we can see the trend in their trade receivables.
What do those tell us?
They tell us that the amount of money owed to them by customers was rising substantially. It went from around 5,800 lakhs in FY20 to over 9,000 lakhs by FY21. That trajectory continued. Now, some of that is just because revenue is growing.
Of course.
But it's a figure that needs extremely careful management. Even though MTPL has strong bargaining power because of their premium products, they have to collect that cash efficiently. Otherwise, a strain on working capital could end up offsetting some of the benefits of this big CapEx push, especially as they're onboarding a massive new client like Grasim.
Okay. So the clear takeaway here is that MTPL has placed a massive high-stakes bet, a 280 crore investment that's led to a short-term drop in profits and a doubling of their interest payments.
But the upside is potentially enormous structural growth. The clock, however, is ticking on getting those new assets running at full tilt.
The high-stakes nature of this whole pivot requires really precise monitoring.
It does. And for anyone who wants to see continuous updates and even live chart analysis on this exact trade-off ROCE versus CapEx, and to track how quickly they are absorbing these costs, you should join the Catalyst and the Cup YouTube channel. It's all in our company Brewing series.
Perfect. So now we pivot completely. We have to look at the future outlook. This is where, as we said, 70% of our analysis needs to be. This is the part that has to justify that enormous financial commitment.
The entire story, the entire investment thesis hinges on the success of these next few growth drivers.
So where do we start?
We have to start with the most exciting, highest margin piece of the puzzle. The Pharma packaging segment. This is their next big structural moat, and it's the biggest potential driver for recovering those margins we just talked about.
So what exactly are they making for the pharma industry?
Their strategic entry is focused on 3 high-value areas. First is standard bottles and caps. Second is effervescent tubes, for tablets that dissolve in water. And third is something called desiccant canisters. Production for all this officially launched in the 4th quarter of FY23-24 at their Sultanpur facility.
We need to see some hard evidence that this pivot is actually working. If it isn't, the whole thesis starts to look shaky. What was the performance in its very first year, FY25?
The initial progress is very encouraging. It really seems to validate the strategy. In its first full year, FY24-25, the pharma segment achieved sales of around 11 crores.
Great, a decent start.
But here's the crucial part. Management confirmed that they crossed the break-even level in the last quarter of that year, Q4 FY25. They did that by getting to nearly 50% capacity utilization almost immediately.
Wow. So they went from zero to profitable in a new, highly regulated industry in about a year.
Exactly. That rapid move to profitability, even at just partial utilization, is a very strong signal that the demand is real and robust.
And based on that signal, management is not holding back. They're accelerating, right? What's the immediate expansion plan?
They're hitting the accelerator hard. The current capacity as of FY25 is about 1,500 tons per annum. The plan is to double that aggressively to 3,000 tons per annum by the end of March 2026.
That is a very tight timeline.
It is. It signals huge confidence in their order pipeline, but you're right to point it out. It also raises the execution risk. They have to deliver on that.
So let's talk about the potential here. If they actually hit that 3,000 TPA capacity, what does that mean for their top line? And why is this segment so vital to justifying the overall CapEx spend?
Okay, so let's run the numbers. At a conservative selling price of, say, 300 per kilogram, which reflects the premium nature of this kind of pharma packaging.
Right, this isn't a paint bucket.
Not at all. That 3,000-ton capacity could translate to a maximum revenue potential of somewhere between 90 crores and 100 crores by FY27 or FY28, assuming they get to full utilization.
So on a roughly euro 780 crore revenue base, that is a very meaningful new stream of income.
Very meaningful. But it's not even about the top line. More importantly, what about the margins? That's where the high return on this investment has to come from.
This is the bull case.
This is the bull case. The targeted profitability here is exceptional. Management is guiding for an EBITDA per kilogram to be consistently high, somewhere around 100 to 120 conservatively.
100 to 120 per kilogram.
Yes, and when you compare that to the margins in their more standardized food or lubricant packaging, this segment offers a massive margin uplift for the entire company. This high margin profile is the primary justification for the big initial investment, and it's the engine that will pull up those profitability ratios that dipped in FY24.
So let's dig into how they defend that margin. What makes their pharma packaging so unique? Is it just IML again?
It's a combination of their core moat, the things we've already discussed, plus some bespoke innovation that's tailored specifically for the regulatory needs of pharma. So first, they are the first company in India to use their fully backward integrated IML for effervescent tubes. That process requires incredible precision. Second, for their desiccant canisters, they're using something called advanced laser engraving. This prevents any ink from seeping into the product, which eliminates the risk of contamination.
Which is obviously a non-negotiable for pharmaceuticals.
A total non-negotiable, and that's another first for them in India. But their overall strategic advantage, and this ties right back to their tool room, is the agility in developing faster molds and samples. The pharma industry is notoriously slow with packaging approvals. MTPL's ability to deliver these bespoke, quality-controlled solutions in a short time frame is a killer differentiator.
And it attracts clients who want to speed up their own product launch timelines.
Exactly.
But we have to make sure the client traction is there to support this aggressive expansion. Are these just pilots, or are major clients actually signing on?
The traction looks very strong. We know that over 50 pharma companies have already visited, audited, and approved the Sultanpur facilities. That's step one. More importantly, 20 to 25 of those companies have started actively buying from MTPL in small to medium quantities for now. They're seeing early monthly orders for bottles and caps spread across several clients, reaching significant volumes. Plus, they have a history here. They already have approvals from big, quality-conscious companies like Wipro, Biocon, and Godrej for other products like lotion pumps from previous years, so they know how to navigate the complex audit process.
And they're so confident that they're already planning phase 2, even if it means risking more CapEx strain.
That's right. To prepare for the leap beyond the 3,000 TPA target, they've already acquired an additional 2.5 acres of adjacent land for a future greenfield pharma expansion in Sultanpur. That was another 11 crore investment in Q1 of FY26.
That signals they see this as a long-term structural growth story.
That's the only way to read it.
Okay, let's move to the core business stabilizers, paints and lubricants. The CapEx bet here seems to be validated by one massive locked-in catalyst.
Absolutely. The entry of the Aditya Birla Group, or ABG Grasim, into the paint market.
This is the big one.
This is the stabilizing structural growth element that provides immediate guaranteed utilization for a big chunk of those new fixed assets. MTPL is a committed supplier for Grasim Industries, which is building out a massive new paint division from scratch. This single commitment required MTPL to build 3 new dedicated manufacturing plants.
3 plants for one client.
Yes. One in Panipat, one in Shayar, which already started operations in late Q4 of FY24, and one in Mahad, which is nearing completion as we speak.
So what's the guaranteed growth uplift just from this one partnership?
The guidance is very explicit. Management projects that the ABG business alone will provide an 8% to 10% growth boost to their entire paint segment.
And that's essentially locked in, guaranteed growth.
It's as close to guaranteed as you can get. It's independent of the general market performance, and it ensures that a huge portion of that 280 crore capex will be utilized very, very quickly. It de-risks the bet significantly.
And what about their overall growth targets for paint?
Still very aggressive. They're targeting double-digit volume growth overall, somewhere between 10 to 12% for FY25, with hopes of pushing that up to 12 to 15% in FY26.
And the stability from lubricants and edible oils, is that still holding up?
It is. The lube segment is the steady workhorse. It showed a 3.4% volume increase in FY24, which is solid, predictable cash flow. And the edible oil market, as we discussed, continues to be a great success story. Sales volume there jumped substantially from 20 crore to 35 crore in FY24.
And that was mainly from the new 10-liter pack.
Mostly, yes. It just confirms that their core strategy of displacing old-school tin packaging with their superior rigid plastic solutions is still working and has room to run.
Okay, finally, let's cover the food and FMCG segment. This is an interesting one because they're seeing strong volume growth, but they're also facing a major headwind.
Right, and that headwind is increased competition. The volume growth was solid, don't get me wrong. It was nearly 15% in FY25, and they're targeting 15-20% going forward. But this is where the market pressure is most obvious. Management explicitly noted, and I'm quoting here, a small reduction in realization per KOG in food and FMCG due to competition hotting up.
So they're getting less money for each container they sell.
In that segment, yes. And that's the real risk in a fragmented market. Smaller rivals can and will compete on price, especially for the less sophisticated types of packaging.
So how are they using their new CapEx to fight back against this price erosion?
By getting smarter with geography, they're using the new capacity to cut costs and improve delivery times. The new FMCG production line at the Panapat plant, which is set to start in June 2025, is a perfect example.
How so?
It's a strategic move. It's designed specifically to counter the regional competitors in the North Indian markets by drastically reducing their own supply costs, their logistics overhead, and their lead times to customers there.
So they're trying to protect their margins through efficiency gains, even if the price per unit is a little lower.
Exactly. They hope to preserve or even slightly improve margins through higher volume absorption and aggressive cost cutting, which is only possible because of these new, strategically located assets.
And we're also seeing them expand into some interesting niche markets here as well.
Yes, which shows the versatility of their IML technology beyond just pails. They doubled their sales of IML sweet boxes to nearly 5 CR, and their growth in the cashew market was explosive. It went from about 3.5 crore to 25 crore in FY24.
Wow.
These specialized IML containers for high-end food products just show that they're constantly finding new, slightly higher margin applications, even within that broad, competitive FMCG space.
That's a really extensive look at the growth potential. It seems to validate the strategy, but now we have to turn to the human factor. We've established the financial bet. Now we have to establish our trust in the people making that bet. So we're going to shift sharply now to an analysis of the management team, their track record, and all the corporate hygiene factors. This is our annual report deep dive.
And this is so critical. For a 280 crore investment to pay off, you need absolute confidence in the team that's running the ship. Let's start with the track record and credibility.
The leadership.
The founder, Mr. J. Lakshmana Rao, is a gold medalist from IIM Bangalore. He's been reappointed to lead the company through March 2029. This is the person who is credited with taking MTPL from basically a small-scale industry to the largest injection molding company in India, operating more than 10 plants.
So that long tenure and history of successfully scaling up the business is a massive qualitative plus.
It's a huge asset. But the real test of credibility for me comes down to their capital allocation discipline. Have they successfully executed big projects like this in the past?
Did they do what they said they would do with the money?
Exactly. And the evidence here is a strong yes. Their credibility is significantly bolstered by how they handled previous funding rounds. They raised money through a qualified institutional placement, a QIP, and a rights issue. And the reports confirm that those funds were utilized entirely for the specific projects they were raised for.
So no mission creep, no diverting funds to pet projects.
None. That demonstrates a crucial level of discipline, and it gives you a strong precedent that they can successfully execute this current, much larger 280 crore CapEx phase.
Okay, let's move on to corporate hygiene. Auditors, governance framework. We need to check for any red flags around their earnings quality.
The hygiene here appears to be very robust. Their statutory auditors, a firm called Mrs. M. Anandam & Co., issued an unmodified opinion on their financial statements right through FY23.
And an unmodified opinion is the gold standard, right?
It is. It basically means the auditors found no material issues and believe the financial statements are true and fair. It's a sign of high fidelity and reliability in their reporting, which is essential when you're analyzing a company going through such a big, tension-filled investment cycle.
Now, what about related party transactions, RPTs? This is an area that often gives investors pause.
RPTs are present, which isn't unusual for many Indian family-founded businesses, but the key is whether there's a good governance mechanism in place to manage the risk.
So what kind of transactions are we talking about?
Things like rent being paid to directors for properties or salaries being paid to relatives of key managerial personnel. But management asserts, and the reports confirm, that these are all conducted on arm's-length principles.
Meaning at fair market rates.
Correct. And the critical factor is that all of these transactions are subject to rigorous scrutiny by the company's audit committee. The committee grants what's called an omnibus approval for repetitive transactions. So the existence of RPTs isn't necessarily a red flag in itself, but the existence of this robust, active governance system to manage potential conflicts of interest is the reassurance you need to see.
And beyond RPTs, what other systems do they have in place that confirm good internal controls?
The broader framework looks solid. They have a whistleblower policy and a vigil mechanism, with no recent complaints reported. Their internal financial controls are deemed to be adequate and effective. And, importantly, the board has consistently accepted all of the audit committee's recommendations. This whole system points to a healthy, disciplined structure that should be capable of handling the complexities of this rapid expansion.
Let's pull back a bit and look at management's big picture view. Does their expansion strategy, which obviously requires massive future demand, actually align with what they're saying about the Indian economy?
It aligns perfectly. Their view is extremely bullish on India, which provides the necessary macroeconomic tailwind for their domestic-focused strategy.
So they're betting on India.
100%. Management acknowledges the global volatility, but they see India as solidifying its position as one of the fastest-growing major economies in the world. They're projecting strong domestic consumption growth, supported by construction, services, and a big rebound in rural demand.
Do they give a specific GDP number?
They do. They're projecting real GDP growth of 6.4% for FY25. And MTPL's expansion, the new paint capacity for ABG, the FMCG optimization, it aligns directly with this outlook, especially when you consider that their key end markets, like paint packaging, are projected to grow at a CAGR of over 9% between 2025 and 2030. Their bet on capacity is perfectly aligned with the national growth narrative.
Finally, on this section, ESG and sustainability. For a plastic packaging company, this is a huge topic. Is it just window dressing for them, or are they taking it seriously?
They seem to be taking it quite seriously. They position all their efforts under the banner of sustainable and intelligent packaging. And operationally, they are making some tangible commitments.
Like what?
They're replacing older, inefficient hydraulic machines with modern electric ones. They're installing new water chillers that they claim can save up to 90% of the water used in the cooling process. They're using advanced techniques like FMEA to reduce process rejections and waste. And they also claim that their operational efficiency is so high that wastage from the injection molding process is effectively zero because all scrap material is recycled in-house.
And what about on the recycling front? The post-consumer waste?
Right, the extended producer responsibility, or EPR. As a PIBO, producer, importer, or brand owner, under the official rules, MTPL has to adhere to EPR guidelines. They do this by partnering with recognized recyclers, and they're actively working to source post-consumer recycled material and improve its quality so it can be integrated back into their product value chain. It shows both compliance and a proactive commitment to building a more circular model.
Okay, we've synthesized a huge amount of data here, financial and non-financial. We've covered the high-growth bet and the management discipline that's needed to execute it.
And after this expensive check on their governance and risk framework, I think we can establish a good level of confidence in the management structure. Now, to get an even closer look at their key board committees and the granular ESG metrics that reinforce this confidence, you can join the conversation on the Catalyst and the Cup YouTube channel.
Excellent. Now for our final synthesis. It's time to merge the bull and bear arguments to definitively answer our core thesis question. And to frame this conclusion, we're going to rely on our final piece of investment wisdom, the principle of margin of safety.
Right, and the margin of safety in this specific context is really about how much buffer, how much protection exists in their current strategy to absorb potential mistakes. Because the execution risk associated with properly utilizing that 280 crore capex is extremely high. We need to clearly outline the potential rewards versus the inherent risks.
Let's start with the bull case. What's the reward scenario that could make this a multi-decade growth story?
The bull case, as we've discussed, is centered on Pharma. Pharma provides the high-margin escape route. This is the segment targeting that incredible 120 kilogram EBITDA. It's backed by patented technology like IML EV tubes and laser canisters, and it has a clear path to generating 9,200 crores in new revenue capacity. This structurally de-risks the entire company's margin profile.
And the core business.
The growth in paint and FMCG is basically locked in. The Grasim ABG expansion guarantees an 8-10% growth boost in paint. The new Panipet FMCG plant secures their 15-20% FMCG growth target by taking away the cost disadvantages they had in the north. And finally, their moat defense, their active patent enforcement, and their irreplaceable IML and tool room agility, it cements their premium position and makes them resistant to generalized price wars.
A very compelling bull case. But now, for the bear case. What are the 2 or 3 biggest risks that could completely derail this massive investment and keep their profitability metrics suppressed for years?
The number one risk, without a doubt, is execution risk in the pharma segment. That incredible margin is entirely contingent on them securing client certifications quickly, and that could even include approvals from global regulators like the US FDA.
Right.
If the ramp-up at the Sultanpur plant is delayed for any reason, a scenario management has kind of hinted at by acknowledging initial hurdles, or if those major international certifications take longer than expected, that promised high-margin revenue could be pushed out to FY27 or FY28 or even later.
And that timeline is critical.
It's everything, and it directly compounds the second major risk, which is the ROCE trade-off. The recovery of their profitability is entirely dependent on rapidly utilizing these brand new, very expensive assets. Failure to do that quickly means they're stuck sustaining those double finance costs and suffering from a low asset turnover, which would prevent the ROCE from ever recovering to its target level.
And the competitive pressure in their legacy segments isn't going away.
Not at all. That acknowledged small reduction in realization per kilogram in food and FMCG is a persistent threat. While the new Panapat plant is a great offensive strategy to cut supply costs, if the price erosion from competitors outpaces MTPL's ability to absorb new volume and cut costs, we could see margin erosion accelerate in their traditional stabilizing segments.
Okay, so based on this really rigorous analysis, let's bring it all together. Let's provide our final conclusion and definitively answer that core thesis question. Can management execute this high-growth strategy?
I believe the answer is yes, but with a major condition. MTPL's core business is premium rigid packaging, and it is fundamentally differentiated by its IML and backward integration capabilities. The evidence strongly supports management's historical discipline and their ability to execute a high-growth strategy.
The strategy predicated on the big spend.
Predicated on successfully leveraging that massive euro 280 crore capex. Structural growth is, I think, ensured, provided, and this is the big condition, that the high execution risk on converting the Sultanpur Pharma capacity into actual sales is minimized and executed on schedule. Successfully achieving that is the key that unlocks everything. It's what will justify the recent short-term pain in their profitability and what will secure their competitive position for the next decade.
So for our listeners who are tracking this high-stakes story, we need to define the critical check engine lights, the 3 operational milestones to watch going forward.
Okay, first, you have to watch pharma capacity utilization. We need to see if they meet that aggressive goal of doubling capacity to 3,000 tons per annum by the end of FY26. And more critically, we need to see their sales progress. They hit the 35-37 crores target in FY25. We need to see that move towards the aggressive 55-60 crores goal for FY26. If they hit that, it confirms the high margin diversification is working.
Milestone number 2, the financial recovery marker.
Second is the asset turnover ratio. You have to track the movement of this ratio. Watch it climb from its current low point toward that targeted 2.5. This single metric is the best indicator that those expensive fixed assets are being fully utilized. It directly signals that they are successfully absorbing their fixed costs and resolving the capex ROCE trade-off.
And finally, they have to deliver on their core business commitments.
Third is the new plant ramp-up. We are watching for successful commercial operations and significant volume contributions from the Panapat FMCG plant, expected in June 2025, and the ABG Mahad paint plant. Success here ensures that the geographical diversification is delivered and that they are meeting the committed structural growth in the paint sector that is being driven by Gresham.
So it seems that while a plastic container may be an everyday sight, the sophisticated IML technology, the commitment to IP defense, and the high-stakes financial strategy behind Mold-Tek Packaging elevate it far beyond just something on your kitchen shelf. As Peter Lynch famously advised, invest in what you know. But in this particular case, the key is to very closely monitor management's ambitious bet on high-quality capacity expansion, especially that pivot to high-margin pharma, to ensure that the reward truly justifies the very substantial capital commitment.
For more cold, hard analysis just like this, remember to subscribe to the Catalyst and the Cup YouTube channel.
Disclaimer: this discussion is for informational, educational use. It is not financial or investment advice. Consult advisor. Perform due diligence before investing.